So I wanted to break down some mortgage strategy spotlight for the middle of October. Today is October 11th, and just wanted to talk through a little bit about some of the confusing parts of the market right now. Really important right now to stay informed. Mortgage strategy always wins over fear, and there's just a lot of noise out there. So I thought it'd be a good opportunity to kind of go through where we're at right now. So first and foremost, lots going on this year. I think we lose sight of how unique 2024 is. We have a whole new NER contract and compensation model that is being adopted as of August 17th. So it's been a big change for a lot of the real estate industry. We have obviously mortgage rates, volatility. We've seen a wide range of mortgage rates. To think a year ago, we were at 8.03 on average in October. And this month, we've gotten as low as the low sixes. So really important, lots of volatility. So we also have the Fed for the first time indicating mortgage rate cuts. So that's significant. We have a severe lack of inventory. I'm going to show you some slides on that. A lot of pent up demand. A lot of people want to re-enter the market, but they're concerned on rates. And we have an election year. We keep forgetting about an election year. A lot of volatility, uncertain for that. We have record high home prices. So even with 8% interest rates last year, home prices went up close to 4 to 7% nationally last year. And we have a lot of affordability concerns with high rates and high home prices. So lots to absorb, lots going on. So average 30-year fixed this week, ending today around 6.64%. If you look all the way to the right-hand side, you have 8.03 a year ago. Okay, that was about the high of where we were in the last year, and as low as 6.11, and that's been in the last 30 days. So confusing to a lot of people that we would have a Fed rate cut, but then rates would go up about 0.5%. It's not as surprising as you would think. And the main reason why is because most of the move, rates were around 7%, a little over 7% in April. And once it was kind of known that the Fed was going to be in more accommodative stance and rates were going to move lower, rates moved all the way down. So we almost saw a full point reduction in rates since April. So the fact that we've bounced up, remember, rates don't go down in a straight line. There's going to be some volatility in there, and there's going to be some times where we have to reevaluate where we're at. So it's very, very important to know that volatility and understand that volatility. Put together some points on why mortgage rates are moving higher. So economy is a little bit stronger than expected. The job market is coming in a little bit stronger. The job report, first Friday of every single month. So for September, that came out in October, the job market surprised to the upside, meaning there were more jobs created than expected. That is not good for inflation, and it's what the Fed is watching for rate cuts. Okay. Federal Reserve is data dependent. So as the Fed watches this data, they're going to be on their future rate hikes dependent on the data that's coming in. And there's some confusing economic signals. On one hand, we've had a huge move lower in inflation, and we've seen the job market deteriorate a little bit, but haven't seen it deteriorate in the level that we would like to see. Not that we want to see it, but that's what the Fed is looking for. Little new data ahead. So here we are going into an election, but we have little data coming in over the next few weeks. So what makes that a little bit more difficult is that little data ahead, is not a lot to move the market. So the market is going to kind of fluctuate a little bit here and could drift and not move in the direction that we want. So that data that we're looking for is probably not going to be for weeks. And we're going to have the election. So we don't have a lot of reason for rates to move lower in the near term. Plus, you have a lot of global uncertainty. You have a lot going on with other countries, wars, and that creates uncertainty, which is never good for mortgage rates. So to put it in perspective, because I think it's really good, kind of where we were a year ago until now, on a $400,000 loan, October of 2023, average 30-year fixed was around 8.03. Average 30-year fixed on September 18th, okay, was around 6.15%. That is a difference on a $400,000 loan amount of $506.52 per month. So when we talk about affordability, that is a massive move in affordability. So it's really important to keep that in mind and to know and understand the differences. Now, these are averages, and every situation is going to be different, but it's important to note that $506 per month, that helps massively with affordability. So really important move. Do we expect rates to move lower? Yes, we do. But that's always a very dangerous game to play with the concern of rates moving up. Moving down quickly, and all these new buyers entering the market. That creates a really struggle with demand and inventory, which I'm going to show you some slides next. So just to put in perspective, we've heard a lot about inventory increasing, and I always like to show this. This is a national number. I'm going to show you some Illinois numbers. On a national number, inventory is up 36% year over year. So if you just take that number, you think inventory is much higher, and it is, okay? But you really only have to compare it back to one number, and that's 2019 levels. Inventory is up from some of the record lows during COVID, but we really have to look back everything at 2019. That was when we had a normal market before COVID, and we are still 23% lower than where we were in 2019 on national inventory levels. That is why home prices are continuing to rise, is because we still have record low inventory, and we still considered it record low in 2019 before COVID. So really important. But Illinois tells a very different story. So in Illinois, which I have it circled in red, these are inventory levels year over year from September of 2023 to September of 2024 is up 15% in Illinois. Seems like a lot, but again, we have to compare it to 2019. And in 2019, we are still 62% lower in the state of Illinois than where we were in 2019. This year, 2024, September of 2024, October numbers are not out yet. They'll be out probably the first week of November, but still 62% lower. So think about that in Illinois. You know, we have record low inventory. And just to put it in perspective in Illinois, because I think this is really important, September of 2024, we had 786,000 active houses listed and not under contract. So these are active listings in Illinois. And when you actually look at September of 2023 versus September of 2019, in September of 2019 in Illinois, we had 56,651 active listings in Illinois. And today, okay, we have 21,000. So as a buyer, you have to ask yourself, if home prices are going up at 8% interest rates last year in Illinois, around 7%, and we expect interest rates to go down, and we still have record low inventory that's more than 60% lower than where it was in 2019. What do you think is going to happen when mortgage rates move lower? We're going to have a rush of demand and not enough homes to meet that demand. So it creates a struggle for buyers re-entering the market. So it's really important to know and understand inventory levels. You know, obviously we can't time the market just like we can't time interest rates. This is where strategy comes in and is so important to re-enter the market when you can afford to, not trying to time interest rates, because that's when everyone else is going to be getting in. So inventory is a very important dynamic to know and understand, to know where home prices are going. So what do you do now and what to watch moving forward? So you're going to continue to see election volatility in the next 30 days. Unemployment report is not going to be coming out to the first week of November. We are going to have the election, which is going to have volatility. We are going to have a Fed meeting, and we are also going to have an unemployment report that the Fed is looking for future rate cuts. It's going to be extremely volatile, okay? So you're going to want to watch that unemployment report. You're going to want to watch inflation news. The next 60 to 120 days, I feel, are the most critical to the market over the next 1 to 3 years. And the main reason why is once rates start to come down, it's going to be very, very hard for people to get offers accepted. So the opportunity is to enter now with the hopes of being able to refinance down the line. You never want to go into it with the expectation to refinance. I think a lot of people got that wrong recently. But remember, mortgage strategy always wins over fear. It's something I always say, and it truly is what I base my business off of, because that is where we have to talk about strategy. It's more than interest rates. We have to look at monthly payment, cash to close, when to enter the market, how to get offers accepted. And right now, we're going to have a lot of people that are kind of buying into a lot of the noise. And the next 60 to 120 days could be the most critical for you to get the house that you want and the price point that you want, with the expectation of home prices moving up once rates go down. I say this a lot, but I am more worried about home prices than I am anything to do with interest rates. I believe interest rates will be lower a year or two from now. My concern is home prices and how high they go with the lack of inventory that we have in Illinois. So if you have any questions, feel free to reach out to me and my team. As always, we're available 7 days a week, 7 in the morning to 11 o'clock at night.